He's angry about mortgages. It's Angry Mortgage. He's swearing. He's cursing loud. He's old. He's opinionated. And he's been doing this so damn long. This program is about mortgages, and this is mortgage advice, but the advice may not apply to your situation. Contact licensed mortgage professionals for specific recommendations before you make decisions about mortgages. You may not agree with Ron, but if you don't, he thinks you're wrong. Oh, and did we say there is a lot of swearing?
Hey, we're back.
We're back.
All right, folks. It's Ron. It's Jan. It's Angry Mortgage. It's Butler Mortgages, the brokerage. I'm Ron Butler. Jan is sick today.
Unfortunately.
Jan is unwell, but she's a trooper. She showed up. She's here doing the podcast. Trying to figure out what it is. What do you think it is?
I don't know. Like you said, it might be COVID. Could be. I feel it more in my lungs, so maybe it's bronchitis. Who knows?
Here's the deal. I believe that if you have headache, cough, and
body aches, feels like you've been hit by a truck. Yeah,
that's COVID.
Most likely.
Look, folks, there's people running out of the room, or they're wiping down
They're going to be like, Ron, you need to run.
They're wiping down their phone right now. They're wiping down their phone right now with a sterile cloth, saying, "Oh my God, is COVID come through the phone?"
Someone's going to say, "Ron, you should be wearing a mask."
Of course,
or I should be wearing a mask.
Yeah, well, they're going to say a lot. Okay, they're going to say a lot, folks, please, everybody listen out there. It's the flu with a different name. Okay, Like it wasn't the flu when it first showed up. It killed a jillion people.
Yeah.
I'm not one of these anti-vaxxers. I'm not a pro-vaxxer, but I'm not an anti-vaxxer. Okay. Like I've always scratched my head and thought, the government promised that if we took the shot, COVID would vanish. I remember that.
Yeah, but like anybody who understands how vaccines work should know that that's not how it works.
Sure, but the government, the bottom line is the government lied to us. The crazy part is the government fired shit tons of people for not taking. Yeah, that's all wrong. Okay. Let's be clear. Before everybody starts going, he's one of these anti-vaxxers. He's crazy. He's like a Joe Rogan with a tie. This fucker. Okay, no,
he was driving one of those trucks.
There's a truck. He's up in Ottawa in the truck. Okay, with a tie. Anyway, listen. No. I get sometimes I get 2 boosters a year for COVID. I'm old and I'm fucking fat and I fucked up and
if you're in the at-risk group, then sure.
I'm 67. I'm in the group. Okay, so I'm not anti-vax, but firing the people about not getting vaxxed when the whole story of this is going to end COVID as soon as we're all, that's crazy. That ain't right. Okay, so lots to talk about today. Rates. So mortgage rates have come down. I keep talking about mortgage rates coming down, but I want to get a little more technical today. So, because all across Canada, banks and credit unions actually published a rate reduction this week. Okay. Now, it's really important that the public understand. I think it's important if you've got a mortgage that you understand there's 3 different rates from banks. Okay. And let's face it, banks do I don't know, 80% of the business, 75% of the mortgage business.
A good chunk, but is that still the same, even though a lot of people don't qualify as the same?
I think you're quite right. Alternative lending has grown. The alternative institutional lending has grown, private lending has grown, but still, banks are they're still the majority of mortgages in the country. Okay, and I'm going to throw in Desjardins Credit Union in Quebec because they're a big force in Quebec. Even though they don't sort of rank, when you see the rankings of banks, you don't always see Desjardins because they're not a bank, they're a credit union. So, but they are a huge force in mortgages in Quebec. But let's just face it, the rates have all come down. There's 3 different sorts of rates the banks have. There is a posted rate, which is just fuckwit crazy high. Okay.
Can you explain the posted rate again?
The posted rate is a traditional thing. We got to realize banks have been around for 150 years. Right? They're really old businesses. So they have some old-fashioned things they do. So posted rate was always a rate that the bank actually, believe it or not, when everybody went to the branch, was sort of a rule that banks had to post their rates in like a window. Like you had to, the public actually had to see a sign with rates on it. That's where the word posted came from. Okay.
Oh, okay.
So but posted rates now have become a different thing. Posted rates are very, very high. Like they're enormously higher than the bank's real rates. And, but they're used in penalty calculations by some banks. Some banks, if you read your contract, it'll say, we're going to base your penalty on the calculation that starts with the bank's current posted rate.
Got
okay.
it.
So that's just a category of rates that are used, again, it's historic, but it's also used in penalty calculations, mainly to try to make for a bigger penalty. So that's the truth we're told. Then there's the bank's regular rate sheet. They issue a rate sheet to mortgage brokers, for instance, across Canada, and to their own sales group, and that's their rate sheet. Okay, and those rates are much less than posted, and all of those rates on rate sheets went down in Canada last week. Not by a ton, but they went down. Like some went down 5 beeps, 10 beeps, 15 beeps, depends on the product. And remember, folks, a BIP, or there's always a controversy, BIP or beep. Okay.
It's just BPS, right? It's not no actual E's. Okay.
Basis points.
Yeah.
Stands
However you want to say.
Basis points is 1/100th of a percentage point. Okay. Anyway, it's really the beeps versus bips thing is weird because it's also regional. Like, so some in the States they say one thing more than the other, and sometimes people make fun of you. Hey, he said beeps, it's bips. Like, okay, fuck yourself. I'll say whatever.
It's not even a real word.
It's not even really. It's not even
an acronym.
Real word. Really, you're right. It's not really even real. But yeah, so they all came down a bit. Now the final rate, this whole thing started with posted. Then we got a rate sheet, and then we got discretionary rates. So discretionary rates is situational. In other words, the banks print this rate sheet. And let's say, for the sake of argument, a 3-year fixed on the rate sheet is 5.29. Just for the sake of arguments, that's what it says, 5.29. And then you have rate discretion. In other words, that's what it says in the sheet, but we're going to get you less. We're always going to get you less. So why do that? Well, it's like this, because it's very situational. For instance, if your mortgage is a big mortgage, like it's $750,000, and it's going to close right away. It's going to close in 30 days, 45 days. Okay. And you're a great customer, like great debt ratios. You've got great credit. It's a great property. It's not some, you're not buying like, this used to be a windmill and we've turned it into a house kind of shit. Or this was a school and we've turned it into a house. Yeah, no. Okay.
It meets all the criteria, basically.
So right now, all the people who are living in converted schools are starting to put in the comments section, "You're full of shit. It's the greatest thing in the world." Okay. But like, I'm just saying, it's an extremely good customer, closing quickly, and a big mortgage. So why closing quickly? Well, because there's hedge costs. So a hedge cost means that if I'm going to give the customer a rate and guarantee that rate, and he doesn't close for 110 days, then I've got to pay a kind of insurance if I'm a bank. It's sort of an insurance that says, okay, if rates go up during that period of time, I'm not going to get killed. Okay, I'm going to hedge that rate. Okay, but when it's 30 days or 40 days, you don't have much hedge to worry about. It's going to close quickly. Okay, so if that perfect person, and if the rate sheet says 5.29, maybe the discretionary rate is 4.89 or 4.79. Okay, it depends.
Right. Yeah.
Why do banks build it this way? Because banks reasonably want a chance to think about how good this new customer is.
Right. That's
reasonable, right? Okay. Yeah. Like it's like, okay, who is this? Is this sort of a borderline customer who's never going to use any of my other products? They're never going to put any money into RSPs. They're never going to put, Yeah. It's reasonable that banks think about who their customer is and how good a deal they want to offer. There's a lot of things like that in the world, right? Like, somebody was telling me the other day that if you want a super expensive purse from like Hermes or Gucci or one of these, what's a famous bag?
Fendi, a Birkin.
Okay. But have the opportunity to buy certain highly prized bags, you got to sort of come into the store and create a relationship. Like you got to buy a bunch of other shit you don't really want, like belts and other things, in order to get to the level where you can actually ask for the best bag and pay a fortune for the best bag. Is that true?
I'm not a huge designer person, but I believe so. But I do know that if you are traveling, then it's cheaper to buy it in Italy.
Oh, hell yeah. Absolutely. Cheaper to buy. Yeah, 100%. Yeah, it's better. Yeah.
So, I mean, hey, if you're spending that money on a bag, you might as well get a trip out of it too.
I guess what I'm saying is that every company has the right to decide how they want to work with their customers.
For sure. Like if you walk into a designer store and you're just buying this one, like let's say something more on the lesser side, I don't know, like Louis Vuitton. It's not Birkin prices, right? You know, Louis Vuitton, you can walk in, get like a $500-$600, little side bag, whatever. If you just walk in and buy that one product, they see that you're not in the system. They're like, oh, okay, here you go, whatever, who cares? Yeah. But if you are a like frequent flyer type of thing where you're constantly buying Louis Vuitton products, and I'm sure just the customer service and who knows, maybe even like the loyalty benefits are much better.
So when a sort of a limited quantity bag comes out, they let you know. And
exactly. You're on the list to know first. Okay. Yeah.
So let's imagine, folks, that a very good discretionary mortgage rate is like you're a top customer at Louis Vuitton, and you get that the best bag. You still pay full pop, but you get
first dibs.
You get first shot at the best bag and the one that they're not making many of. So that's what we got in mortgage world. We got discretionary rates, which represent the lowest rate that the bank is prepared to offer based on their analysis of you, the customer, and the mortgage, and how quickly it closes, and how big is it, and lots of other stuff. Okay, so those are the three types of rates, but all of those rates have dropped in Canada, and they've not a ton. But remember, if you're frequent listeners to the show, my mantra is that rates are going to continue to come down, and that's what's going to continue to happen. Okay, so we get to the point now where if we actually know that rates are going to be a lot lower next summer, because they are. So they're good, whatever rate we're looking at today. If we're looking at a 3-year, let's take for example the 5-year. So 5-year high ratio. I realize few people qualify for that, but high ratio, 5-year fixed. If you qualify, it's 4.39 for 5 years. It's 4.34. Okay, not
bad. Yeah,
super low. Okay, but by the way, that's only for purchases, folks. It's not for refinance, not for renewal. If you're looking at that a year from now, theoretically, that should be 3.59, 3.69, in the summer of next year, fall of next year, which is a lot less. Yeah. Okay, so what about conventional rates? So let's say a conventional rate on a 3-year today is 4.79 for the sake of argument. By next year, which is say Labor Day a year from now, 4.09, 4.14. So it will be less. So this brings up the conversation of, well, what rate do I take then? Because for the last couple of years, 3-year has been very popular.
Right.
And by the way, people who took a 3-year 2 years ago, looks like they were right. Yeah. By the time they finally get to renew, they're going to renew into a much lower rate environment than when they took it. Okay. And so they would have been worse off if they took a 5, because they would have to wait 2 more years to get into the good rate environment. But what should we do today? Because like next summer isn't far. It's only a year, right?
Yeah.
So is a 1 year the answer? Is a 1 year fix the answer?
Wouldn't people, I think I'm still iffy on the variable, but wouldn't people want to take variable then?
Great point. Okay, that's a great point, and you summed it up really, the whole dilemma of variable perfectly. People just still don't feel comfortable.
Yeah.
They don't feel comfortable with variable. It's still more expensive. Like variables like 5.75, 5.85, 5.9. But it will come down maybe 3 more times this year. Like in other words, you could have a rate. If you can find a 5.75 variable, you can find a rate that's like, it could be at 5 as early as Christmas. okay, and falling. And then it'll fall next year to the point where you're at like 425, 415.
And then once it's better in the summer, you can just lock in, right?
You can conceivably lock in. But people are still nervous about variable. Like, let's face it, folks. Bless you. There were some horrible goddamn experiences people went through.
People are traumatized by variable. 100%. I'm sure.
Absolutely. You nailed it. People are still, it just sends shivers down their spine.
Yeah.
Like what happened? There's two groups of people. There's the people who got crushed by it, by seeing, they had a rate of 145 and it went to 6, went to 7. Almost, it was nuts. Okay.
It's crazy.
So they're traumatized. The people who took a fixed and then watched variable go nuts, they're breaking their arms, patting themselves on the back, saying, "See, I was right. Variable always bad." Okay, okay. So there's that two groups of people, which makes this emotional decision. The reticence of going with variable is there. 100% right. But if you took a 1-year fixed, okay. But the trouble is, 1-year fixed is really high.
Yeah,
it's in the 6s. Like it's in the mid to, in some cases, high 6s. So you say to yourself, "Holy shit, I don't want to." I don't want to pay that much. Yeah. Okay. 2-year, we've seen some 2-year down as low as 509, 499. So 2 years come down, but it's still an attractive rate. The 3-year fixed, it's just probably the wrong theory. Okay. Because let's face it, if you can believe, and I mean, I can't guarantee this shit, right? Like, I can't give any guarantees.
Not after what we've seen. There's no guarantee in this market.
But I can tell you what the balance, a high balance of probabilities is, barring geopolitical event, that we will see either a 3%, 2.75%, or for some of the aggressive people, some bank economists are predicting a 2.5% Bank of Canada rate by next August. Okay?
Ooh, okay.
Yeah, way down. Okay?
Yeah.
And that's just a function of things we've talked about on the show. Bad economy, growing unemployment, falling inflation. Because if you destroy an economy, that's a great way to fix inflation, right?
Yeah.
It really works well. I mean, if people can't afford to buy sweet fuck all, then prices come down. Yeah, that's exactly right. So we're seeing that. So look, I mean, I think you need to talk to your advisors. Right now, we are having, at Butler Mortgage, we're having serious conversations about moving off the 3-year with our, by the way, we just do what people tell us. If you have the right to make your own financial decisions. We can just advise.
Yeah.
Okay. But if you say to me, "No, I'm not comfortable giving me the 3-year fixed," we're going to find you the best rate 3-year fixed we could possibly find in Canada. Okay. That's our goal. If you say, "Give me 5-year fixed," we're going to give you 5-year fixed. Don't worry. If you have a belief in a rate that you feel is right for you and your family, we're going to get it for you at Butler Mortgage. But at the end of the day, our recommendation pattern has started to switch to, have you considered a variable? Would you consider a 2-year? There is a case for a 1-year. So in other words, we're trying to give good advice.
Right.
But at the end of the day, the customer has to feel comfortable.
Yeah.
That's it. But times are changing. I mean, there's really no question that sometime by the end of this year, the U.S. Fed will drop. And once they do, well, they're going to keep dropping. I mean, just the way cycles work, folks. That's just the way it works. All right, so talk about real estate. The truth is that once these prices all drop, will real estate take off?
Aren't we technically in a buyer's market right now?
Technically buyer's market. And before everybody starts screaming, well, no, it's not a buyer's market. The comment section, everybody screams, not a buyer's market. Price is too high. Rates too high still. Why are you talking buyer's market? Look, it's just a fucking technical term.
Yeah.
It's a technical term when there's a shit ton of people offering their house for sale.
Yeah.
That's called a buyer's market.
Yeah.
Okay. When houses are sitting for a long time unsold, that's called a buyer's market. Now, it may not work out for anybody. Everybody may look at the prices and say, "You're stupid. It's still too high. I'm not going to buy it."
Right. But there's multiple available.
Whereas in a seller's market, the houses are gone in a week.
Hot commodities.
Boom, boom, boom. Okay. So yes, that's why it's called a buyer's market, because houses are sitting, listings are sitting. They're not just flying off they're getting sold right away. All right. So that's true. question becomes, now that we know, we don't know, but we have our balance of probabilities, we believe that rates will be significantly less next summer. Will house prices take off in the spring? Will sales boom?
Hopefully not, because I mean, like, sales, yes, but prices, they're already so expensive. Like,
yeah, right.
The way that house prices have grown in the past like 10, 15 years alone, it's huge. I can't imagine at least like half of Toronto being able to survive in a market where we have the same growth again. Like, it's hard.
You're absolutely right, and you've probably nailed the issue. There's just a point where you can't go any farther.
Yeah.
Like, people are discovering this in rents right now. Folks, you should know that rents are slowly falling in 416. I know that's hard to believe, but
I know, because the average rent in Toronto is like $2,000 right now.
No, it's like 2,600. It's like nuts. Okay,
it's crazy.
but it's coming off. Okay, and to your point, it's coming off because people just can't fucking afford it.
Yeah,
it's over. Like, well, couldn't you get somebody to room with you and afford it? Well, guess what? In a fucking 480 square foot shoebox condo, how many fucking people are you going to fit in there? One barely works. Okay, so yeah, no, there is an ultimate point where prices don't make sense anymore.
Yeah,
we've seen this in the condo world right now, in small condo, and there's a point where prices come down. But will much more attractive interest rates, so we're talking about interest rates that were in 2022 and parts of 2023, they were in the 6s, okay? Coming all the way down to like 4%. Shouldn't that encourage? Well, fact is, if the economy is shit, no, prices won't rise, okay? Because there will be a little more activity, and there will be some, depending on if it's a scarce product. Like, here's what we got to realize. We have started to create enormous scarcity in Ontario and British Columbia in the large cities in single-family homes. Okay, we've just created scarcity. So, because we didn't build any. We haven't built any for years, okay? Or built very few new ones. So there's a scarcity, and that will push those prices, or at least maintain those prices. Don't get me wrong, they can still come off a bit. But when something is very, very scarce, may not come off a ton.
Of course,
okay? We're going to discover that when you build way too many dog crate condos, that prices can fall, and we're going to find that out in the coming months. But no, there is that dichotomy. Will this be a moment when mortgage rates fall and prices don't go through the roof? Because they're usually tied. Usually they're very closely tied. But hey, listen, if rates went down to 2.49, then things would take off, okay? But they're not going to. That's not going to happen. So we got to realize at 4% with a 2% qualifying rate, so you got to qualify at 6%. That's hard. It's still hard.
It is.
And it's gonna pull down sales. So building of new homes in Ontario and British Columbia has fallen off a cliff.
Construction's bad.
Construction's bad. I mean, the projects the cranes are up. They're going to finish. By the way, when I keep talking about cranes, we need to understand that in the GTA and in big, in cities in Ontario, like Kitchener-Waterloo and even Ottawa, the growth in building has been in high rise. Okay, everywhere.
Yeah,
okay? Like in Hamilton, high rise in Hamilton. Okay, everywhere we look, high rise. So when the projects finish, and there's been no projects, hardly any projects started for 14 months. High rise projects started because the math doesn't work.
Yeah,
like the government's charged too much tax. The interest rates are too high. The ability of people to pay for those expensive units, they're very small.
Let alone qualify.
Doesn't make sense. So the rents are coming off, so that investors who buy these units to rent say to themselves, well, fuck, the math doesn't work on this at all, so I'm not going to buy any. So big slowdown there. There are still units getting completed, because obviously we started a shit ton of units in 5 years ago, and 6 years ago, and 4 years ago even, but nothing for 14 months, hardly any new development. And here's an interesting part of this piece, that CMHC, and, sometimes people like to pick on CMHC. Oh, yeah, it's all bad. They're bad people, government bad. Well, sometimes they do good. Mm-hmm. And CMHC developed an excellent program to promote purpose-built rentals. Right. So that's where you build a tower not to sell as condos. Mm-hmm. You build a tower that will be permanently rented to people, managed professionally.
Yeah.
Okay. And it's different than condos. Like condos have, they put a lot of store into there's a gym and there's a party room and there's all these amenities. So
these are like the basics.
It's basic, but it's but they're typically slightly larger than the condos.
They are decent sized. There's quite a few of them in my area, and they are decently sized condos. Sure, they're expensive for no amenities, but I mean, you get the space.
You get some space, because part of CMHC's program is to encourage reasonable places where people can have families. Mm-hmm. Okay? At least don't feel squeezed if there's two people living there. Okay, and this was a good program, and it was it wasn't a government giveaway. Like it wasn't. It was just CMHC facilitating at a cost. There's insurance premium associated with it. At a cost, facilitating lower rates and easier to get started construction. Okay, mm-hmm. And it worked really well. Mm-hmm. So of course it was working really well. So naturally they changed it.
Oh.
So it's not going to work anymore. Mm-hmm. But it'll work fine in lower cost parts of Canada.
Yeah.
It'll work in Atlantic. It'll work in the prairies. It'll work like in northern BC and in the smaller centers in Alberta. Mm-hmm. But it won't work in major centers in Ontario or. It'll work. I don't even think it'll work in Montreal, to be honest with you anymore. Mm-hmm. Okay, because their rents have been growing.
Yeah,
and their prices have been growing. So it may work in Montreal. It may not. Okay, it'll be right on the cusp. Okay, mm-hmm. But definitely in Ontario, it's fucked. Okay, it's just they basically the reason it's fucked is they said, we're going to take away a bunch of these. We're going to take away a bunch of this other conditions and emphasize more low pricing, but the rent number they're using to represent low cost rents is from 2019.
Oh. Well, those are different times.
So the number just at bottom line, it doesn't make sense anymore. So we will see less of those. So it's typical of the government when something actually is sort of really working, they change it.
It's like literally the opposite. If it ain't broke, don't fix it. Mm-hmm. If it's working, break it.
Jeez. Now, maybe I'm being overly critical, and one of the factors is that it was working too well, and they were just starting to become a snowball. Okay, and maybe they worried about that it would get too carried away. So I can't look into their minds, but. You know why purpose-built rentals is good? Because the rents are too fucking high in this country.
100%.
So there's two kinds of supply. There's supply of rentals. Mm-hmm. And can we just all agree that the old theory for the last 20 years that rentals should be owned by small investors isn't ideal?
No.
Okay. I mean, it isn't ideal because there's just way too much rent eviction, way too much people are never sure from year to year whether they're going to be able to stay.
Yeah.
And that's fucked up.
It is.
Totally fucked up. So that's the flaw in that theory that, okay, well, we'll just have people buy condos and they'll rent them out. Okay. Mm-hmm. Yeah, except they want to sell sometimes or they just change their minds. Mm-hmm. And all of a sudden a family who's lived in a place or people who've lived in a place for 2 or 3 years, you got to go, get out. Mm-hmm. Okay. But that's the shits. Okay.
Yeah. So
if you have purpose-built rentals, that's professionally, they're never going to be anything but rentals. Mm-hmm. You stay there for years and years. Okay. Maybe you don't. Maybe you do. Maybe you can move on.
Yeah.
But you can move on in your own terms. Right. You're not being thrown out by the landlord. Mm-hmm. Okay. And that is the central flaw of the private enterprise, like the mom and pop investor system of rentals. That's the central flaw of it. Things change and you got to leave. And that's hard.
They get to choose whenever.
It's not your decision. It's not the renter's decision. You just got to go. Yeah. Get out. So that's not a great thing. Mm-hmm. All right. We have our usual we have viewer mail, listener mail. Let's find out what we got.
This one says, I have 2 pre-construction condos closing in 2026. I listened to the pod and I'm worried about what they will be worth. What to do?
Well, it's a legitimate worry. The condos that are closing in, from 2025 and 2026, particularly if they're in the GTA, I don't know where this location is. In theory, if it's in Alberta, it might be okay. I don't know. Okay. But if it's in the GTA, if it's in the 416 particularly, this could be, a problem because I've covered it before. If you've bought a pre-construction condo and you're paying $1,280, $1,310 a square foot, and right across the street from your soon-to-be completed condo, you could buy a resale condo that's only a couple of years old for $925 a square foot. Yeah, fucking problem on your hands.
Right.
Okay. And higher rates. Because the rates are not going back to 199, 249. Rates are going to be, at 4. And that's still, there's monthly maintenance fees for the condo. Yeah. There's property tax, and the math of rents may not work at all. So guess what? You need to seriously think about what to do. If you have stuff closing in 2025 and 2026, hope that things get better is not a fucking strategy at all.
Right.
Okay? You should take action now. 18 months goes fast. Okay. And try to sell it by assignment, even if you don't make any money, even if you take a loss. Okay. I know some people go wild when I say that. You're a crazy fucker. People should just close. And, if they lose a little money every month, well, how about if it's a lot of money every month? Okay. Yeah. And if they wait like 2 or 3 years, the prices will come back and everything will be fine.
But who says they can afford to pay that for 2-3 years?
No shit. Exactly.
Not only that is, why would you risk losing your home on like power of sale?
Yeah, you're right, because if it becomes absolutely unmanageable, it's a whole house of cards that falls down.
Exactly.
So my advice to anyone who is worried about their condos closing in 2025, 2026, keep a close eye on the market in your neighborhood. Keep in the neighborhood. You know where that condo's being built. You know where it is. Okay. Keep a very close eye on the resales in that neighborhood. Check it like weekly. Like get a great handle on what's going on in your neighborhood in that particular area. And if it looks like shit, this isn't. Look. Just sometimes it's good just to get out, and sometimes it's good to take a small loss, as opposed to taking an unmanageable, uncontrollable loss.
Yeah.
You can sell by assignment. Doesn't always work, but you can try to sell by assignment, but at least prepare. Like you got to look at how am I going to handle these down payments? What if the value is less? What if the bank sends an appraiser in and they say, well, you paid $680 for this condo, but it's only worth $605. Okay? You got to come up with the money, the difference, more down payment.
Right.
Okay. So please watch it carefully. Think about it. Do not be an ostrich. Do not put your head in the sand and think just hope it's going to get better.
Yeah.
Okay. It probably isn't going to get better.
This one says, my bank just reduced my home equity line of credit from $200,000 to $100,000. What the hell? No one called, no notice, just saw it on the statement.
All right, so we've covered this before in the show, and I do like the question because it's going to be happening more often. It's going to be happening all the time soon, so I do like the question. Look, it's a demand loan. The thing about every line of credit, every credit card, every personal line of credit, these are demand loans. Demand loan is a simple concept. The bank can do whatever the fuck they want, whenever they want. That's a demand loan.
Right.
Okay. Now, they're not crazy. I mean, they don't purposely destroy people. I know there's going to be a couple of comments come through in the comments section. You are wrong. They destroyed me. Okay.
The bank was out to get me.
I'm sorry. If things go wrong in bad circumstances, then yes, you feel destroyed. I'm not trying to say that's not a real thing. But at the end of the day, and in some ways I blame bankers a bit. I'll tell you why. I don't think anybody who's got a credit card understands it's a demand loan until something goes wrong.
Yeah.
Okay. I think the majority of people who get in trouble on credit cards are shocked when things go awry. Your credit card is closed. You can never use it again. You have to pay us back right away. What the fuck? Okay. All I did was miss $10 minimum payment. You're crazy. I know. Bad things happen to good people sometimes. But that's what it is. Yeah. It's just the bank can do with a non-mortgage loan. Now, why do I say non-mortgage? Because mortgage is different. Mortgage is a bilateral contract. You've signed and the bank signed. And it has very specific conditions, most important of which is if you pay it all on time and you keep up your house insurance and you pay your property tax, the bank can do nothing with that mortgage. Right. Can't change the rate, can't cancel it. Nothing can happen. Absolutely nothing can happen. You've got a few contract conditions you have to meet as a borrower, and the bank has to, as long as you do those things, the bank has to honor what they've said. They have to honor the rate, they have to honor the term, they have to honor the payment. They can't change sweet FA. Okay? So that's the positive about a mortgage, and that's the risk you take in a demand loan. Credit cards, personal lines of credit, home equity lines of credit, they're all demand loans. The bank can ask for their money back whenever they want. That's just something we have to understand. So a limit, and by the way, a limit reduction might not be the worst thing that ever happened to anybody. Like it just means you can't get more credit or you have access to less credit. Okay. It's not like they said you've got to quadruple your payments.
Yeah. Like exactly.
But it is reality.
Yeah.
Okay? That's reality of how it works. Okay. By the way, I just wanted to go go back to some things we were talking about earlier. And one thing I really want to emphasize is that when I talked about rents, I wanted to point out that the disease of high, sky high, batshit crazy house prices, which, sort of has its epicenter in, Vancouver and Toronto. But it spreads. It's like a goddamn virus. Okay. And batshit crazy house prices will inevitably, people like to say, no, you're wrong. It's rents are supply and demand. Well, yes, they are. But if the friggin' house is like ridiculously expensive and you want to rent it out, or you have to rent it out, you're going to try to want to get the highest possible goddamn rent you can. Of course. It's not like you paid $200,000 for the house. I mean, like you paid $1.5 million. Okay. So yes, it's a problem. And here's what happens. And we've observed it, and everybody in these areas will tell you it's true. The high prices in Ontario and British Columbia push people sometimes to say, well, I'm going to sell here.
I'm going to leave.
I'm going to leave, and I'm going to move to a cheaper place. And the cheaper place is Atlantic Canada, or it's the prairies, or it's far north, whatever it is. But once people start to flood into those places, they push the prices up. Now, some part of this virus is even more fucking insidious, okay? It's people saying, oh, I can't make any more money buying investment properties in Ontario or British Columbia, so I'm going to buy investment properties in Atlantic. Yeah. I'm going to buy it in Calgary. I'm going to buy it in Edmonton.
I've had that very thought.
Right?
Let me just buy in Alberta because I can't afford here.
Sure. Yeah. But and that could be fine. That could be absolutely fine. But if you're a real estate investor and you say, I'm going to buy in Halifax because compared with Toronto, it's cheap. I can put on a big HELOC on my Toronto property and buy a bunch of properties in Halifax. Well, guess what? You are in a Toronto fucking state of mind, and you look at the cheap rents in Halifax, and you like some evil fucking genius in the movies, you say, hey, I know what I'm going to do. I'm going to double the rents in Halifax, okay? And then I'm going to make real money. Ha-ha! Well, guess what? You're upsetting like a delicate ecosystem of rents in a province where there's not a ton of high-paying jobs.
They're not making Toronto money.
No,
there's a reason why their rent is not Toronto rent.
Yeah, there's no CEOs of any fucking banks living full-time in Halifax, okay? There's none of the top lawyers that service those banks. There's none of the top of, like, I'm not saying Halifax ain't a great place. It's a wonder. I've been there. I've been to Halifax several times. It's a great town, okay? Great town, great people. Some of the nicest people you could ever meet in your life. Anyway, bottom line is no super high paying jobs, not to the same extent.
Right.
And if you try to push those rents through the roof, you're harming the whole population. It's a rental fucking virus.
Yeah.
That's just nothing but bad. And we see it. We've seen it in Alberta. We're seeing it in Atlantic Canada. And it's just a bad, bad thing.
Oh, man.
Which brings us to our favorite part of the program.
What the actual fuck?
So I'm going to make the tiny change in what the actual fuck. And I'm going to say, why the actual fuck?
Why?
Like, I'm going to say this. And it just, we covered the Claire Drage promissory note fucking disaster a lot.
Yeah.
Okay. And it was a disaster. It's people who just, through knowing Claire Drage as a mortgage broker for years, for being her client or for being an investor in mortgages with her, they suddenly decided that when she offered them promissory notes, and she told them, by the way, promissory note is, there's no fucking security. Promissory note is a pinky swear to pay you back, to pay you an interest payment, and to pay you back someday. Okay. It's a pinky swear. There's no property behind it. Your name is not on the title of the house with the mortgage, none of that stuff. Okay. So it's relentlessly more dangerous than a mortgage. At least with a mortgage, your name is on the house.
Right.
Okay. If you lend money in a private mortgage, your name, I can show you a search and there's your name. Okay. On that house. You're part owner of it. Okay. So maybe $100 million lost on this fucking Claire Drage disaster. Okay. And she's disappeared. She's in the wind. Okay. Like, she went personally bankrupt. All her companies went into receivership. She gave up her mortgage broker's license. Boom. Good luck chasing her now. How do you chase her? She's gone. She's financially disappeared. Okay.
Wow.
But why the actual fuck is anybody getting these promissory notes? Okay. Like, and I have learned that there's others doing promissory notes all over the province because promissory notes became part of something called BRRRR. Okay, so BRRRR is real estate fuckery for buy, renovate, rent, refinance. That's BRRRR. The concept of easy money. Like anytime somebody says to you, hey, this is easy money. This is a sure thing. We're just going to mint money on this sucker. Please don't listen to that. Now, here's the horror show is that it's like any Ponzi scheme. It works for a while and you get your payment. Like you signed up for a promissory note that pays 10%. Big money, right? That's great money. It pays 10%, 11%, 12%. Who the fuck knows? Okay. And you're getting the payments. So you think, great. So you get the payments for a year. And then the person who sold you the promissory note, which, by the way, almost always these people are either mortgage licensed or real estate licensed who are doing these promissory notes. So they have sort of and they've known you before. Right. They know you. You did business with them before. There's a relationship
that's built.
There's a relationship. There's a level of trust. Okay. And they say, oh, you've done great for the last year. Maybe you want to put in another $200,000. Okay. And then one day, like Claire Drage, the payments stop. Right. The payments stop, and everybody's looking at each other saying, what the fuck? What's going wrong? Okay. And ultimately, probably a lot's gone wrong. We hear about situations like this on smaller scales, maybe some on bigger scales, but there's problems in Kitchener-Waterloo with a few mortgage people there who've done these promissory notes, problems in Hamilton, problems maybe in Windsor, some issues cropping up in Toronto. Like, this is devastating shit.
Why can't the regulator get involved and put some red tape around promissory notes or just kind of get rid of them overall?
Great question. Okay. The truth is, it's really, really hard for the regulator to wrap their arms around people loaning money to each other.
Right.
Like if you say, all right, you can't do promissory notes. You as mortgage brokers can't do promissory notes. The mortgage broker who wants to do promissory notes says, okay, that's fine. I'll just have somebody else in my company do it.
Right. There's always
who's not licensed. Okay. Because this is the purest thing in the world. This is the simplest thing in the world. These are just people It's an IOU. Remember?
Yeah.
I don't know if you've ever heard of this movie Dumber and Dumber. Dumber and Dumber.
Dumb and Dumber.
Dumb and Dumber.
Yeah,
okay?
yeah, something like that. Yeah,
Dumb and Dumber.
Yeah.
There's the crazy guy in Dumb and Dumber says, look, this is the same as money. It says IOU. Okay? It's the same as cash. No, it's not fucking the same as cash. So my rant today is, please, people, if you are involved in real estate investing, if you're involved in mortgage investing, and this is a small podcast. There's not a shit ton of people listening. There's thousands of you, and we thank you deeply. Tell your friends to subscribe, please. But if you hear of anybody ever talk about promissory notes, people in your family, your friends, people you know, just say no. It's like fucking say no to drugs. Just say no. Just please don't do these promissory notes.
Or send them the link to our podcast and they'll know why.
I'm telling you, just don't do it. Like if you hear about it, if you hear members of your family with it, if you know of anybody thinking about it, if you know people who have these promissory notes, tell them to ask for their money back.
Cash out.
Quickly as fucking possible.
Cash
okay?
out.
This is not a good thing. Get your fucking promissory note money back and tell the world, just say no to promissory notes.
Yeah.
Thanks, folks. See you next week.
If you like the pod, well, don't just sit there. Go to YouTube, Apple, Spotify, and all the other ones and like the pod. And don't forget to subscribe so we can keep being angry at mortgages and swearing about mortgages. Angry Mortgage could use your support.